All right, welcome back, friends. We have Keshav Bhajanka, CEO of Century Plywood, joining us. Very good afternoon, Mr. Bhajanka. Your first reaction, does it help your industry, your sector, and how?
Good afternoon. I think it's a great budget. I think it's going to help the entire country as a whole. As you know, in the past few months, consumption has been a bit of an issue as far as the economy is concerned. And the rationalization of tax slabs, the increase in exemptions, I think this is going to go a long way towards promoting consumption, and it will benefit everyone, not just us, but all industry.
All right, not just you, but all industry. And then do you see consumption economy picking up, Mr. Bhajanka?
100%. I think that is the objective which Honorable Finance Minister has made this change with. And I think going forward in the next few months, you will see a spike in consumption levels in the economy. As disposable income goes up, you will definitely see a recovery, and this should help boost or increase economic growth even further.
All right, I'm told Adit Palicha, CEO of and co-founder of Zepto, is also joining us. Adit, are you enthused, excited with this budget, with the kind of disposable income middle classes, maybe lower middle classes, those earning below 12 lakh rupees would have? It's going to sort of spur the e-commerce sector, e-commerce economy?
We're incredibly excited about it. I think the theme of the budget was quite clear, and this tax break for the middle class. We're already seeing like early reactions pouring out, but as a consumer tech company, I think this is going to be a big tailwind for us. But more importantly, I think what's most impressive about this budget is that the government now for almost a decade has been consistently moving this country towards a free enterprise thinking that innovation and building technology companies and building industry is what will grow the economy and lift people out of poverty. Yeah. And that consistent free enterprise, innovation backward, entrepreneurship backward thinking is what I'm most impressed by. And this was one other big step in that direction of changing this country.
Yeah, Adit, also, the finance minister announced some social security measures for the gig workers, and gig workers essentially contribute a lot to the infrastructure, superstructure of e-commerce. Actually, do you see this adding to your costs in any manner, or you think this is a good measure?
No, overall, I think it's a good measure. I mean, our first instinct as a company is to always do best for our delivery partners and our gig workers. And I think the best part about this budget is that in a big way, the government has realized the employment value and livelihood value of gig work and these internet companies. I think historically people have demonized this for some reason, but the reality is when you speak to our delivery drivers on the ground, like as I speak to them, you'll find a 21-year-old that's trying to get through his BCom that needs the 20,000 rupees and is able to work flexibly on Zepto and make 20,000 rupees a month, and it's a life changer for him. Or the industrial worker that's moved from Hoskote back to Bangalore and doing a much safer job, making more money from before what he was doing informal work below minimum wage. So it is actually an uplifter, and the government's recognition of that in the budget is very, very encouraging.
Yeah, Adit, just stay with us. I have a couple of more questions for you, but I want to get Mr. Bhajanka also involved again in this conversation. Mr. Bhajanka, you spoke about your sector and overall economy getting a boost. There is a consumption boost really built into many of these measures. But for example, specifics. Let's get into specifics. The announcement of National Manufacturing Mission, focus on shipbuilding. You think there are going to be tailwinds specifically to your industry, your sector with this, and to what scale?
100%. I think, a lot of the initiatives, for instance, 1.5 lakh crores to states, interest-free, towards infrastructure, towards capex. All of these initiatives are definitely going to help us. The focus on tourism, our products go into all sorts of real estate, whether it's residential, commercial, so on and so forth. The focus on manufacturing is clearly there for everyone to see. The finance minister has also mentioned that there is going to be a huge push towards exports, which has been happening, but I think it is going to be further reinforced now. So I think all of these are definitely going to act as tailwind in both the short and the long term.
All right, stay with us, Mr. Bhajanka. Adit, coming back to you, do you see a fillip coming in for a tier 2, tier 3 town a push coming in for e-commerce to create space for itself in tier 2, tier 3 towns? Because as of now, it seems to be limited to, those bigger metros, 10 lakh plus geographies. You think this is going to create newer markets for you, for e-commerce?
100%. I think, for us, we've already expanded pretty aggressively over the past 6 months into dozens more cities, right? We've launched, everyone from Nasik to Vizag to Kozhikode to Kota, right? Dozens of cities over the past couple of months. And actually, counterintuitively, the reaction we've gotten has actually been better than the early signs we had when we launched our metro cities, right? The counterintuitive reality is that the tier 2, tier 3 consumer in India is actively looking for better options, looking for better service, better pricing, better selection, right? And when you give them that service, similar to what you'd expect in a Bombay, Bangalore, with a lot less competition, right? At least in our space in e-commerce, right? And the offline players that exist, we actually just get better adoption rates. And I think this is just going to add buoyancy to that. I mean, they're already, tier 2 India is already growing faster for Zepto than Metro India. And I think this is just going to accelerate it.
Okay, Adit, last question before I let you go. You are yourself a wonder kid, tech wonder. The manner in which you have, at such a young age, really shepherded this SaaS ecosystem and created a niche market for yourself. Do you see a fillip coming in for tech in the budget in terms of a push for a greater talent pool in the STEM sector, and then perhaps that creating a better ecosystem for your kind of enterprise?
100%. Look, I think the thousands of crores of capital has been allocated by the government to support entrepreneurship, right? When Indian talent around the world, right? I dropped out of Stanford, came back to India to build this company, right? And I know there are dozens of Indians that I know personally that are actually some of the best talent that we have that are excited about coming back to India and building interesting things, right? And when they hear the government talk about entrepreneurship, invest in entrepreneurship, right? It just gets people more and more confident about the long-term India story and dedicating their lives to building this country. And so we definitely saw that tone. But what I'll say is that, what's becoming clearer and clearer in Indian tech is that we need to have great internet and technology companies in India. If you look at the US and China, the people that are, most of the companies building these foundational language models are tech companies, consumer internet companies like Facebook, like Amazon, like Alibaba, right? Or Google, right? These started as consumer internet companies and then became more and more evolved and are now building foundational tech and infrastructure. We don't have large internet companies in India that are generating, thousands of crores of capital.
Yeah.
I think if we create that next 5 years, then you'll start seeing these, interesting technology infrastructure coming out of India as well.
All right. Thank you so much, Adit, with those insights. And I would request Mr. Bhajanka to stay or joined in by Mr. Nilesh Shah, MD of Kotak Mutual Fund, as also Mr. Santosh Iyer, MD and CEO of Mercedes-Benz India. And let me begin with Mr. Iyer. Mr. Iyer, do you see this budget meeting your expectations for your segment of the economy?
So traditionally, luxury is always a sentiment-driven demand. So in that sense, if the sentiments goes up, and that we have seen today's budget, I think it's quite positive with a consumption-driven approach. We clearly feel that should drive sentiments, and we should also be able to participate in the growth. So in general, yes, to answer to your question, but for us, significantly, we have always been saying India believed in small garden, niche, or I would say niche garden, high fences. The budget has tried to answer both the spectrum. One, they have increased the garden now by putting more money on people's pocket to spend and consume. And on the other side, there is a lot of announcement on reducing tariffs. I think that's the way to integrate ourselves into the global supply chain and also become more global. So I think it addresses both in a very pragmatic manner.
Okay, one more question, Mr. Iyer. There has been this talk that there are headwinds insofar as the auto sector is concerned. You see some of those concerns getting addressed insofar as, for example, overcapacity is concerned?
No, absolutely. I think the headwinds was because of high interest rate and inflation also to a bit with a lesser disposable income, and car is a discretionary purchase or even two-wheelers for that matter in that segment, because consumers would not shift from public transport to two-wheelers and two-wheelers to cars and later on to luxury cars. So in that sense, I think the budget with more money available for consumption, definitely consumers will now be able to shift, and auto sector should be positively also benefited from this.
Right. Thank you so much, Mr. Iyer, with those insights. Let me introduce Mr. K.K. Mistry, is non-executive director of HDFC. He's also joined in. But I want to go to Mr. Nilesh Shah. He joined before. And Mr. Shah, everyone would be wanting to hear from you, your insights. The economic survey yesterday talked about overbought markets, not just in India, around the world, sort of suggested that there is already an element of heating happening, and yet the Sensex was up 600 points. Today it does not seem that enthused. How do you read that?
I don't think so. We should waste time in analyzing day-to-day movement of market. That's futile exercise. I haven't met anyone who can predict tomorrow.
That's, as always, pithy and beautiful, Mr. Shah. But then your takeaways from the budget.
I think the budget has delivered Triveni Sangam as expected by the market. The first was fiscal prudence. Not only we have decided 4.8% lower than budgeted estimate this year, 4.4 next year is also lower than expectation.
Yes.
And the 6-year guidance map to reduce debt to GDP ratio will ensure that we'll leave more assets for our kids than the debt burden on them. The second thing was to support urban consumption, and Keshav Bhai will agree that this budget has provided boost to urban consumption through tax concession, especially at the middle class. The third was continue focus on capex, as private capex is on the back foot. Collectively, between state, central and PSUs, the capex will be revised, will be up by about 17%. So higher capex, boost to urban consumption, and yet path of fiscal prudence. That's the magical Triveni Sangam achieved in the budget. I'm sure economy will benefit out of it, and market will recognize the same.
Even if a little late, but you say these are the hits of the Triveni Sangam. Any misses according to you, Mr. Shah?
So one big miss according to me is India has about $1,100 billion, $1.1 trillion in FX reserves and market cap. Now, we don't know what is the actual book value, what is the actual investment in PSUs, but I'm saying that PSU bank trades at 1x price to book and PSU trade at 2x price to book. So let's just take for a simplification market cap as the total investment of government. On about $1.1 trillion of investments, the dividend income is just about 3%. That's a fairly low number. We don't want to compete with hedge funds who will generate 10-11%, but there are many sovereign wealth funds which generate 8, 9, 10%. If we can move this 3% dividend yield or return on sovereign assets to, let's say, 6, 7, 8%, imagine the money which will be available to the government. I think government should seriously consider launch of Bharat Wealth Fund on the lines of GIC, Temasek, ADIA and Norges, so that this 3% return on investment can double.
All right. I had a couple of more questions with you, Mr. Nilesh Shah, if you could stay, because I have to get in Mr. K.K. Mistry also on this. Mr. Mistry, are you sort of disappointed that there is not much focus or as much as you would have wanted on the housing sector, for example? Though, of course, it's a big plus, I believe, for insurance coming in with 100% FDI.
No, I think we have to look at this as a very, very comprehensive budget, which looks at every segment of the economy, whether you are looking at agriculture, you are looking at MSME, you are looking at education, tourism, energy, exports. So every segment of the economy has been looked at. Now, what was it that we were really, what at least I was looking for from the budget? There were maybe 4 or 5 things. First, I was looking for a boost to consumption. which I thought was extremely critical in the current environment, because ours is a domestic consumption-driven economy. And by leaving more money in the hands of people, by increasing the exemption limit for taxation, clearly money has been left in the hands of people. And this will boost consumption, and consumption will boost growth. So one way to look at growth is government continuously spending money, which there is an increase in the amount that they are going to spend on infra. But more importantly, by boosting consumption, by increasing demand for goods and services will increase. And if demand increases, then with a lag, companies will be required to put in more capacity, put in more capex to be able to satisfy that demand. So we meet the growth criteria, we meet the consumption criteria. Thirdly, we meet the job creation criteria,
right,
because all the reforms that have been brought about will create more and more jobs.
Right. Mr. Mistry, there was this overhang that credit offtake is going down. The finance minister more than a couple of times mentioned how she intends to, focus on this. So be it through personal loans, be it through MSME credit offtake. Do you see that whatever has been announced by the finance minister is actually going to help the banking sector in terms of better credit offtake?
Yeah, I'm sure it will help the banking sector also. I think the most important thing as far as the banking sector is concerned is liquidity. We have seen a period of relatively tight liquidity for a variety of reasons. One is the fact that the dollar had become extremely strong, and to support the rupee so that we don't see a very sharp drop in the rupee, RBI has been rightly intervening in the forex market, selling dollars, and because they've been selling dollars, they've been sucking out some amount of liquidity. And we saw that on Monday. There was a boost of or a variety of measures which have been announced by the RBI, which will clearly infuse 2.5 to 3 trillion rupees of money into the system. And I think when we see the credit policy next week, we will probably see more measures towards injecting liquidity into the system. So I think with liquidity coming back into the system, with consumption increasing, clearly demand for bank loans will also go up.
Right. You see better financialization as a product of all these measures?
Yes, I do.
All right. Santosh Iyer, going back to Santosh Iyer. Santosh Iyer, you said that this rising tide raises all boats. You harped on sentiment, and because of which maybe it will help your sector also. I want to focus on this national manufacturing mission. And the focus on strengthening the PLI wherever it can. Do you see some spin-offs for you in those announcements?
No, for sure. I think there has been a lot of discussion, and in fact, I think we are still studying the fine print. One, there has been a prima facie seems to be tariff on some of the imported cars seems to come down, but we need to study the fine print there. But on the local manufacturing side, machinery, for example, used for EVs, there are separate subsidies and capital, I would say, support for some of them. So we need to read the fine print really to see what does it help. But for us, actually, as a multinational, being in India for 30 years, the biggest announcement was also the setup of a high-level committee on regulatory reforms. This is something, if you have an ambition to now start exporting, trying to do something out of India, then definitely this participation in the global trade ecosystem, which was always a challenge with a different type of tariffs, which there is a clear signal and intent. One is reduction of tariff slabs from 15 to 7. And then, of course, simplification is the key. And then participating and trying to normalize tariffs. This will help in the long run for India as well to not only manufacture cars or bikes or automotive for India, but then also for the rest of the world.
Right. Nilesh bhai, I want to come back to you. You were mentioning about whether the dividend kitty of the government can be increased. I was going through numbers. This year, for example, the government got about 55,000 crore rupees from dividend from the PSUs that it owns, vis-a-vis just about 8,000 crore rupees by way of divestment. So the government already treats the public sector as a family silver. It's not wanting to now give it up. So you're saying that the government can actually, there is a scope to increase the dividend income even further?
I'm talking about return on those investments where dividend is just one portion. If you look at GIC, Temasek, Norges, they'll all be making high single digit in dollar terms from a return point of view. If I include even RBI's kitty in the total PSU investment, we are generating roughly about $38 billion as return, including dividend and some of the divestment. I mean, that number could be substantially higher if we manage them well. For example, let's look at our oil marketing companies. They all trade in mid-single digit PE valuation because there's no clarity on whether they will be allowed to price their product professionally. Sometimes when crude prices are higher globally, they still keep on selling at losses. Now, if that comfort is given to market that they will be pricing their products commercially, then certainly those PE ratios can go up, and on the divestment of those OMCs, we'll get better revenue. So it's all about giving professional freedom to PSUs to manage their businesses well, and in turn get better valuation from the market, and move this 3.5% return on government's investment to probably somewhere around double of that, in line with global sovereign funds.
Right. One more question to you, Mr. Shah. Mr. Mistry was mentioning about the tight liquidity situation that existed, though RBI sort of has tried to address that. On the side of the North Bloc, you think the finance minister, through her statement today, has shown herself to be aware of the liquidity situation and then has done something about it?
So as Keki mentioned, undoubtedly there is a squeeze on durable liquidity driven by a couple of things. One, government balances earlier were kept with PSU banks. Now it is parked with the RBI. That takes away about 2 to 2.5 lakh crore on an average from the banking system. Second is the FX intervention, which is running into lakhs of crore. And third is the currency in circulation increase, which leaks away liquidity. RBI did wonderful work by giving OMOs, buy-sell swaps and VRR to provide liquidity to the market, but still they need to do a little bit more to increase durable liquidity. Liquidity is like oxygen. If it's not there, it's not there. So we believe between this budget, which is on the path of fiscal prudence, RBI will get more confidence to provide durable liquidity and also cut rates on February 7th, which should be growth supportive.
All right. You think it's not going to be inflationary?
Inflation, if we see, our core inflation is about 3% in line with our trade partners. It is the food inflation which remains on the higher side. Now, in the CPI basket, food inflation is about 45% weight. But if we see household surveys, food spending is about 35%. There is a 10% higher representation of food in the CPI basket, which increases headline inflation by 50 basis points. If you make that adjustment, our inflation is lower and within the RBI's target range. Yeah. And with this kind of fiscal prudence, I think inflation should remain under control. Obviously, we need divine intervention. The rain god has to be kind enough for our food inflation to remain under check.
Yeah. Okay. I have one more question to you, Mr. Nilisha, but let me get Mr. Mistry also. On the insurance bit, I think he left unanswered. Mr. Mistry, this announcement on 100% FDI in the insurance sector, what are the spin-off benefits you see of that coming in, like in terms of more funds, more insurance funds coming in, more FII, FDI, more money coming in and having benefits for the infrastructure sector, among others? What are the spin-offs you see of this decision?
I think it is a signaling more than actual money coming in at this moment. Over a period of time, more money will come in, but immediately it is a signaling to the Western world, signaling to the rest of the world. India's economy is opening up even further. Now, one other thought could have been if they had increased the foreign ownership limit to 100% for the banking sector. And the reason is that the banking sector has a very large weightage in various indexes. If you look at, and Nilesh would probably be the best person to talk about it, but if you look at the MSCI index, the weightage of Indian banks in the MSCI index is curtailed by the fact that the foreign ownership limit is capped at 74%. If you were to increase that to 100%, you could get a lot more money coming in almost immediately, because weightage in the MSCI would go away straight away, and there were enough checks and balances to make sure that the banking sector does not fall into wrong hands.
Yeah, Nileshbhai, you agree that that's a miss, because the kind of fantastic capitalization of banks we are seeing, fantastic health insofar as their margins, their NPAs are concerned, it's a bet that the government missed, like the finance minister missed taking?
So undoubtedly we should ensure that India's weightage in the MSCI index or FTSE index is fairly represented. And what 𝐾𝐾 mentioned is one trick through which our weight in the index can increase. Moment our weight increases, passive flows increases, and the active money becomes underweight India, and then they start looking to invest in India. Now this was one low-hanging fruit, whereby one can increase FDI limit in banking to 100%, and you can still control that through that 10% cap on voting. So there are ways and means in which you can convince index agencies that we are talking right, and actually we will be walking left.
Right. Fair enough. So maybe I think the finance minister is keeping the powder dry for later. Thank you so much, Mr. Nilesh Shah, Mr. K.K. Mistry, and of course, Mr. Santosh Iyer and Keshav Bhajanka for joining us. We're still doing a short break. Coming back on the other side, the conversation on the budget continues.
Thank you.